A handful of these are going to be done by me and the attorneys here at my office, but many of them are going to be done by true experts that we bring in, and that's the case now. We have Jordan Bennett with us, with Jordan Bennett and Associates, located in Mission Viejo. He is a realtor and associate broker. I met Jordan through my good friend Wayne Chang, who was our realtor and sold two of our homes when we moved. And then Wayne decided he was done, so he moved and sold his business to Jordan, who has continued to do just the same amazing job that Wayne has always done for us as well. So Jordan is recognized as one of the top 10 realtors in Mission Viejo and top 1% in the nation, which is amazing. And then Jordan and his team specialize in 1031 exchanges, which is what he's going to be talking about today, which is a planning tool that we often use to help clients defer their tax recognition to a later date. So I'm going to turn the time over to Jordan. We're so grateful to have him. We're grateful he took the time out to do this for us. So Jordan, thanks. Welcome.
Thanks, Blaine. Thanks, Paige. Really appreciate the opportunity to talk about this specific topic. That is something I'm very passionate about. So I'm going to go ahead here and share my screen. Is it coming through?
Yes, Jordan. Thank you so much.
Up?
Yeah, it is for us. Yeah.
Good. Okay. So yeah, we're going to talk a little bit today. We're going to hone in on the 1031 exchange, but we're going to talk. I'm going to start off kind of laying the groundwork of just what it looks like to build generational wealth. using real estate as a tool. Some of the reasons that real estate, is such a great tool for accomplishing that goal. Going right to the 1031 exchange would be like talking, about Star Wars Episode 6 before watching Star Wars Episode 4 and 5. So we're going to just, dive in a little bit into real estate as an investment vehicle. I'm sure some of you possibly have considered, diversifying into real estate. Some of you may have your first real estate property. Some may already have a whole real estate portfolio, and some of this may be old news. But we're going to dive in a little bit into kind of the whole topic of real estate investing, and then of course go hone down into that 1031 exchange and how that can superpower your real estate investing. So who comes to mind when you think about real estate investing? I'm sure there's this guy we all know. If we were live, I'd be having you raise your hand to tell me who it is, but we can't do that. So we all know that's Robert Kiyosaki, Dave Ramsey, big real estate investor. We all know this guy has quite the real estate empire. Unless you've been hiding under a rock, you're going to know who that is. Our former president and real estate mogul, Donald Trump. But you're forgetting someone. You and anybody can use real estate as an investment vehicle. And I'm going to talk a little bit more about that today. Just briefly about my background, Blaine did a great job. I'm a Pepperdine grad. I started my career in the Big Four, former CPA, no longer practicing. I've been selling real estate for about 14 years. I've been investing in it personally for about 10. We've helped over 800 clients buy, sell, or invest in real estate. And I'm also Canadian born, just a side note. So that means if you bump into me, I'm likely to say, I'm sorry, even though it wasn't my fault. So my goal today is to make real estate investing accessible for everyone, and to talk a little bit about what does it mean, to build generational wealth, with real estate as at least one of those tools to do that. So we're going to look a little bit at, why real estate, a little bit at types of investments. We're going to dive into how you can supercharge your returns with a 1031. We'll look at some definitions, some basics, kind of the why behind the 1031. And then I'm going to kind of dive into some unique examples you may not have thought of that would be great uses for the 1031. So today I guess talk about the love of my life, residential real estate. I'm sure Blaine and Paige can kind of have the same feeling I have, which is when you're in a service business, where you're helping people accomplish their goals. It's so hard to separate, what you do from who you are, and real estate has been such a part of my life over the last 14 years. I have a lot of empathy for my wife and having to deal with that. So why invest in real estate? It is a great tool to build financial freedom and generational wealth. which that can mean different things to different people. For some people, that might mean the ability to take a trip without straining the budget. It could be putting the kids through college without taking out a loan. It could be retiring a whole decade early. It could also be freedom to contribute to the needs of others. I had a friend of mine, his goal for financial freedom was to be able to buy his parents their first home. They had been lifetime renters, and so he had this goal of being able to purchase a home for his parents for cash, which he was able to do, and it was just an incredible way, to be able to bless, of course, those that raised him. So I'm going to look just very briefly here at real estate as it relates to other asset categories. Everyone is an investor, right? If you've ever owned a stock, a bond, theoretically, even if you have $5 in the bank, you're invested in cash, right? So everyone's an investor. Sometimes real estate can be an intimidating investment because they're big numbers, but because of leverage, which we'll talk a little bit about, real estate is just it's a great asset class, to be diversified into. With stocks, you tend to get a lot of equity buildup, right? People look to stocks for growth, not so much for cash flow. Well, real estate's got that, right? We know that historically the US has done about 3 to 4% average appreciation year over year. California's been more like 8, right? Because we live in a very desirable place. Bonds are going to be great for income, right? People look more to bonds later in life, less so looking for the growth, more looking for the monthly income, right? To pay the daily bills. Well, real estate's got that too, right? We know that rents each year are going up. Even in the Great Recession that we saw from 2008 to 2012, we actually didn't see rents come down. Rent stayed relatively stable. Of course, a lot of folks losing their homes were becoming renters, right? And the beautiful thing of real estate rents is it's unlike a stock where you might receive a dividend. That board of directors can change that dividend. With real estate, you have the ability to determine what's that dividend going to be, and you're the ultimate, decision maker. Real estate is leverageable, which you can do with stocks, but there's always the possibility of the dreaded margin call. No such thing as a margin call when it comes to your real estate loan, especially if you've got a fixed rate. Real estate is a hard asset rather than being a paper or soft asset, and real estate is heavily tax advantaged. So those are kind of the reasons where I really see real estate as just a great asset class to at least have some diversification into when it comes to building your portfolio and your legacy, right? Which is of course something that, Blaine and Paige are helping you to protect and put a fortress around. And, here that's why it's relevant, right? To talk, how do you build, that empire within the fortress. So ultimately real estate is accessible. It's appreciable, rentable, improvable, deductible, stable, livable, leverageable. It's the most able investment. So we've all heard of leverage. We've learned about leverage in physics class, right? Back in 8th and 9th grade. Exertion of force by means of an object used in the manner of a lever. Basically doing more with less. As it relates to finance, right? We're looking at ultimately using other people's money to superpower your investment potential, right? Where you can control, say, $1 million asset with only $200,000 of your own money and $800,000 of, your partner's money. In many cases, this would be the bank. And the bank is an incredible partner, because if that property that you bought for $1 million, where the bank contributed 80%, if that appreciates to $1.5 million, right, 1.5, how much of that appreciation does the bank get to participate in? 0, right? And unfortunately, we saw during the Great Recession, which was a very unique time in real estate, not something we see happen very often. But when people were losing their homes and walking away from mortgages, it was the lender that ended up holding the bag. So they get their monthly payment, but they're a fantastic partner as far as being able to further your efforts and control an asset that you may not otherwise be able to control with your own cash. So of course, there's some cons that come with leverage, right? More risk. If values drop, your capital can disappear quite quickly. That's the other edge of the sword when it comes to leverage. But you get more bang for your buck, and you get to earn income from an asset you may not normally be able to afford. So let's look just very briefly at kind of the different kinds of real estate investments, and we're really just going to focus on the first two. We've got short-term and long-term rentals. We've got fix and flips, investment trusts, crowdfunding. We're really going to talk about this. We're going to talk about holding real estate for the long term. And the reason that's important, and you'll see it's going to tie into the 1031 exchange, because that's something that's going to be a requirement for a 1031 exchange to be successful. So your short-term rentals, you're hearing a lot about this lately with the explosion of Airbnb and VRBO. I hear lots of stories. There's folks buying properties out in kind of the hot vacation rental areas like Joshua Tree, Lake Arrowhead, Big Bear, even places out of state, places like Florida, Nashville, just desirable vacation areas. There are a lot of short-term vacation rentals happening even here locally in Orange County, close to the coast. The challenge is it's highly regulated, and a lot of the Airbnbs out there are actually flying under the radar. And there are ways, to do that, but of course there's risks that come with that because these cities are quite strict on what is or isn't allowed. This is a great platform to get paid up front if you want to have a vacation home for yourself, and it can be very lucrative. I tell clients you can generally do about 1.5 to 2 times your average 12-month monthly rent during the off season, and in some cases as much as 3 to 4 times what would be the typical 12-month rent over like the summer, right? Or whatever is the specific property's high season, right? The downsides are you're gonna get more wear and tear, your income isn't as stable, the rules and regulations, the furnishing, you're not only responsible for the property itself, the cabinets, the toilets, the floors, the windows, but now also all the furniture as well as the cleaning, the utility bills. So it's more like operating a business, than just operating a property. And then of course there's the long-term investor. This is where you're, a lot of times, your average long-term investor, kind of the long-term goal is to get into, multiple properties on the same, parcel. For example, you might have an investor who buys their first single-family home as an investment, then later 1031s that into a duplex, then maybe a fourplex, then maybe, an apartment building, and so on and so forth, to really centralize, the management of that asset with, of course, 12-month rentals. So, the long-term pros, you've got consistent income, you're not kind of ebbing and flowing with what the economy is doing. Generally, once you put a tenant in there for 12 months, in most cases, they're going to pay that rent for 12 months. You've got a legally binding lease, and you can do some due diligence on your tenants. That's not always possible to do on those short-term guests. Some of the cons: lower profitability, less pricing flexibility, and you can't use the home for yourself, right? So that's just a very cursory look at real estate as an investment tool. Probably lots of things there where we could go 10 different directions and do a whole different, webinar on a number of those different concepts. But let's dive into the 1031 and how can you supercharge your returns with a 1031 exchange. So what is a 1031 exchange? A 1031 exchange is effectively when you have a property that has appreciated, usually substantially. You're kind of stuck because you've got a property with all this equity, but to get that equity out, you've got to now pay tax on this long-term capital gain that has been built up while you've owned the property. So an example would be, let's say you bought a piece of property, which, believe it or not, these are realistic numbers. Let's say you bought a piece of property in 2015 even for $1 million. And today that property in 2023, just 8 years later, is worth $3 million. If you were to sell that property, you've got a $2 million capital gain, okay? So keep in mind, one of the things that, what you bought the asset for, its basis, you do get to add any improvements you've made to that asset to increase its basis, which thus decreases your capital gain. You also get to take away from the gross sales price all of your selling costs, right? So the difference between that adjusted basis and your net on the property is your capital gain. And a lot of people don't want to write that big check to Uncle Sam, right? Let's say you had a $2 million capital gain, and between state and federal, you had a 30% tax bracket. That's a $600,000 check that you get to write to the IRS. I mean, that's a big chunk of your winnings effectively going to the government. Not many people want to pay more tax, right? And so the 1031 exchange is a beautiful thing. What you're doing is you're selling that $3 million piece of property we just gave that example for, and you've got the ability to replace that property, and effectively you're selling what's called the relinquished property, and you're buying what's called the upleg property, and you're deferring the tax. And here's the rules with the 1031. We're going to look a little bit at some of the definitions. First off, you've got 45 days to identify what property is going to replace the property you sold. So if I sell a property and let's say it's closing June 30th, right? June 30th is my closing date of my relinquished property. I've got 45 days to identify the property with which I'm going to replace the relinquished property. That's my ID period, okay? Additionally, from June 30th, I've got what's called the closing period. I've got 6 months, 180 days from the date that I close on my relinquished property to successfully close escrow on my upleg property, okay? You've got to have a QI, that's a qualified intermediary. This is also a 1031 facilitator, is another name for this, or a 1031 exchange company. Lots of different terms, right? Your QI is the person who, when that relinquished property is sold, all of the sales proceeds, all of that cash is going into the qualified intermediary's account. Now, why does that need to happen? Well, the IRS says that if you receive 1 penny, if you receive any money in your personal bank account from that sale, that money is now taxable. So it's got to go into that qualified intermediary account. This is not an expensive proposition. Most 1031 companies charge between $800 and $2,500 to act as that qualified intermediary on a normal 1031 exchange. Boot. Let's say you can't put all of the money into use that you've just used, that you've just received from your relinquished property. Well, any proceeds that don't go into that QI account, that go into your personal account, is considered what's called boot and becomes taxable. Okay, so let's look at the properties that you're moving into, your upleg property. There's 2 rules which you can actually choose which one you'd like to follow when it comes to identifying those upleg properties. The first one is the 3 property rule. The 3 property rule says that you can identify any 3 properties that add up to, equal to, or greater than the value of what you sold. And then you can close on 1, 2, or all 3 of them, right? That add up to any value, right? So you could actually be selling a $3 million property and identify a $20 million property, but you could only identify 3 properties like that. And that form actually has to be, it's notarized. It says, hey, we made that 45-day ID period so that our 1031 can be successful. The other rule that some people choose to follow is called the 200% rule. The 200% rule says you can identify any number of properties. You could exchange 1 property and identify 20 properties that you might transact into, but those 20 properties can't exceed 200% of the value of the asset that you just sold, your relinquished property. And finally, and I know that the terms are not the most exciting thing here, so we're almost there. A reverse exchange is where, you got a lot of folks right now that say, gosh, I'd love to, sell this property and 1031 exchange into something else, but you know what? There's no inventory out there. This is a seller's market. What if I fail? What if I can't find something? So some people opt to do what's called a reverse exchange. This is a little bit more convoluted. It involves a trust and some tricky maneuvering. So you definitely want to be in touch with that QI early on. But this is where you're actually purchasing your upleg property before selling what would be called your relinquished property. And that again is a whole different webinar in itself. So at the end of the day, you're selling 1 property, you're replacing it with another or multiple properties equal or greater value for it to be 100% successful and not have any boot involved within a certain period of time. And those are your basic definitions of a 1031 exchange. So to reiterate the why, you're trying to get out of a property, tap that equity, and not pay tax on that equity that you have tied up in that property. There are some other methods other than the 1031 exchange to accomplish this, but of course, again, we're focusing today specifically on the 1031 exchange. So I want to share with you some real life examples of clients either that I've interacted with personally or heard stories from a QI I work with and also other brokers that are in a similar business doing 1031 exchanges. So one reason that somebody might do a 1031 exchange would be to diversify, sometimes into other areas geographically and sometimes into different asset classes. For example, you might have somebody that's got, actually this is a real life story. This was a fellow who had this dream all of his life of owning a trout farm. I think it was somewhere in the Midwest. And he had 3 multifamily properties actually here in Orange County. And so he actually sold all 3 of those properties. And it's the more properties that are involved, the more challenging and it can be to meet the time criteria. But he sold those 3 multifamily properties, and he was actually able to 1031 exchange into this trout farm, which was this passion that he had. And the 1031 ultimately was successful. Another reason that you might want to diversify might be geographically. I'll tell you, a lot of investors are moving out of California. A lot of businesses are moving out of California. Why? It's not the most landlord friendly. It's not the most tax friendly. It's not the most business friendly state in the union. And so a lot of folks are taking their capital here in California and 1031 exchanging into other states, which you absolutely can do. You can move anywhere within the US, and I believe its territories, you can successfully perform a 1031 exchange. Here's another real life example, would be diversifying from old to new. Okay, so there was a client, he had an 8-unit property in Anaheim. The property was from the 1970s. He had a lot of upcoming capital improvements, roofs, exterior paint, termite, plumbing, electrical upgrades, things that were going to need to happen, right? Just also a lot of recurring repairs and maintenance and a lot of management, right? And so this is a client who said, you know what? I'm going to take these funds from Anaheim and I'm going to move them into a 12-unit building in Florida in an up and coming area that was almost brand new. And so for almost the same price, he got newer, which means less repairs and maintenance, less capital improvements to come. It meant actually a slightly higher return on investment. It meant that he got to get 12 units instead of 8, which is a bigger tenant mix, which is again lower risk. You lose, one tenant paying rent for a month or two out of 12 is a smaller fraction than 1 out of 8, right? And he's now in a state that's more landlord friendly, it's more tax advantaged, and in fact he had later plans to actually move personally to Florida, and so now he's got basically planning ahead to have his asset close to where he was going to be personally. And I'm going to say one more thing on this. It would be probably more unusual for someone to go the other direction from new to old, but that does happen too. If somebody is a value add investor, someone who's actually looking for that old dilapidated 8-unit building that they can add value to, do those capital improvements because maybe they're young and they've got more energy and more of a lifespan ahead of them, and they're willing to take that risk to maybe get some value add and build up some equity. That's another option. And so some investors, that's their plan, is they go into a project, they fix it up over a period of years. They do what's called stabilize the rents, bring the rents to market, have those tenants in there for a couple years, and then 1031 exchange into their next project, which brings up an interesting point. 1031 exchanges do not work for flippers. You cannot be someone who's just adding value for the purpose of selling that property and then going into the next property tax-free. It doesn't quite work like that. The IRS is a little bit loosey-goosey. It's a little subjective, but the way they look at it is for 1031 to be successful, that income property that you were purchasing, you had to have the intention of holding it for rental real estate. So do plans change? Can a case be made sometimes that, for someone going from one project to another? Yes. Most CPAs that I've spoken with have said the IRS, if you want to protect yourself, you ought to have income received, rents received for at least 3 tax returns. So if I buy a building this year in 2023, I remodel it, I bring rents to market, I better have rent on my tax returns for this year, for next year, 2024, and then for 2025. And I better not have a history of turning properties, every 2 or 3 years, because that could be something that's looked at, and your 1031 could be voided, by the IRS. So that's something to consider. Here's another real life example: moving from a high risk, high reward, high management to lower risk, lower reward, lower management, or the opposite. So I had a real client. They actually became my client when they were looking out here for a property. They purchased a mobile home park in Georgia in, I think it was the early 2010, 2011, something along those lines. They bought it for $2.5 million. After about 9 years of turning around tenants, cleaning up the mobile home park, getting rents up, et cetera, plus, of course, what the market did over that decade, they ended up selling that property for $10 million or thereabouts. They were getting a 12% return on investment. Why would they sell that asset? something they'd made all that equity. They had, the park was operating great and they're earning 12% on their money. Why would they sell it? Well, because they were 92 and 94 years old and they decided they didn't want to be mobile home park landlords anymore. And so what they did is we actually helped them purchase a medical building in Scripps Ranch area of San Diego that was a triple net. So triple net lease is where the tenant basically operates the building. They pay the insurance, they pay the property taxes, they pay the repairs and maintenance, and you literally, we call it in the industry mailbox money. You get a check at the beginning of each month and you don't have to do a thing, right? So lower return, right? 6.5% return versus 12, but way lower risk, way lower management. And so they were at that stage in their lives where it just didn't make sense to have the high risk and the high management anymore. And some people will go the opposite route, right? They'll take that triplex on the beach in Newport Beach for 5 or 6 million that's maybe earning 3%. And they'll say, you know what, I'm ready for a project. I'm gonna go buy a mobile home park, right? So this can go both ways, but here's an example of something where someone's looking to kind of transition their investment mix, still stay in real estate, but just move from high risk to low risk or low risk to high risk. And finally, this is I like this one. It's really relevant, to estate planning and obviously what Blaine and Paige do for their clients, and it's legacy planning, right? So there's a story. It was a gal who had, I think she had 3 or 4 different properties. No, I apologize. It's the other way around. She had 2 properties, multifamily properties, apartment buildings, and she had 3 children. And the 3 children were not really interested in any of the 2 properties that she had. And not only that, but she knew, hey, 3 kids, 2 properties. Let's do the planning now, and rather than having them, kind of try and figure out later what we're going to do with these 2 buildings, she actually sold those 2 buildings, 1031 exchanged prior to her passing, into a property for each one of the kids that each one of the kids actually got to speak into and have a voice, where it was something that they were attached to, it was something that they wanted, to manage and was relevant to their own lives. So, talk about planning ahead and making life easier, for your heirs when you're gone. So just, a great way to do legacy planning ahead of time is using the 1031 exchange. You're still deferring the tax, still getting the step up in basis on those now 3 units instead of 2, but bringing in the kids earlier, in the process. So if you are already an investor and, one of these examples I gave, a light bulb went off, love to be a further resource or providing any other information along that. You can connect with me online on these different platforms. You can get together with me for a Calendly, Zoom, calendly.com/Jordan Bennett for homes, or you can connect with me the good old fashioned way. There's my phone number, my email, and my website. I so appreciate the opportunity to dive a little bit, at least, take a little bit of a dive into the 1031 exchange, real estate investment. I think it's just such an incredible way, again, to diversify your portfolio, to build generational wealth, and to do something where, again, you're going to impact future generations, whether with, being generous or just, building up something, to pass on to your kids or those close to you. Thank you so much, Blaine and Paige, for the opportunity, and love to dive into some questions if there are any.
Jordan, thank you so much for taking the time to do this. One of the biggest things, I've been listening to it, and I'm somewhat familiar with 1031s. I've done a couple with clients, but the main thing that we see all the time is, you always have to plan for these, right? And so make sure that you're in contact with your advisors, so that you can foresee, if you are looking to, make some sort of change in your portfolio or your lifestyle or however, or just life is changing in general, you have a plan in place for how you're actually going to do these things. Because we get a lot of calls that are like, yeah, we're going to sell next week and we want to do a 1031. Well, that really isn't going to work all that well. So I was just saying, it's always good to plan for these ahead of time. And so we get clients that come in and want to do these because they're going to sell their property next week. And, although it may be able to be pulled off, there's a lot of planning that can go on ahead of time and should go on ahead of time before, doing one of these. So let's see if we have, Charlotte, I'm going to have you jump on, see if we have any questions from our participants today.
I don't see any questions yet.
Okay.
But if anyone would like to put it in the chat, we can ask Jordan the question.
Blaine, can I say something real quick?
Yeah, absolutely.
So I think one of the most common things that I see investors and owners of real estate, they make this mistake. They say, I bought this property for $1 million and, it's generating $20,000 a month, right? I'm getting net 15% on my investment. I mean, why would I ever sell this? And they're making the classic mistake that they're looking at the return on their investment rather than their return on equity.
Yeah.
They forget that the building's not worth $1 million. That's great you bought it for $1 million. It is great. And it's especially great if you got a low interest rate, you got a low property tax base, and those things have to be considered too when you're thinking about doing a 1031 exchange. But if that property is now worth $3.5 million, your equity position is what you need to be calculating your return on.
Yeah, it's now 5%. It's now 5%.
Yeah, it's now 5% or less, right?
Yeah. So yeah, definitely. Now, what are some of the pitfalls? Because I've also seen and never seen this with you or your team, but sometimes people will sell. They think they have a property ready. It doesn't. It falls through. What are some of the pitfalls that can pop up, and how do you best avoid them?
Yeah, like you said, I mean, you hit the nail on the head when you said plan ahead. I mean, you don't want to make a decision. What you don't want to do is be like, yeah, I'm going to put my property on the market right now because the market's hot, which it is, and I'm going to sell it, and then I'm going to find something else. Well, what if, like you said, what if you don't find something else? I mean, here's the perfect scenario. You have to close on the up leg after you sell your relinquished property.
Yeah.
But that doesn't mean you actually can't have your up leg property in escrow when you put your property on the market ready to go, right? Yeah. So that's one thing that you can do is actually line them up where you literally close on the relinquished property and then 2 days later you close on your up leg. Yeah. And you've already identified it when you put your property on the market, right? And so one thing you can do there is you just negotiate a long close on the up leg in case it takes you a little bit longer to sell your relinquished property than you thought it would. Another thing you can do is if you're worried, you haven't identified it yet, you're pretty sure you'll be able to though, you'll be able to identify that up leg property, is when you put your the property that's going to be relinquished into escrow, you negotiate with the buyer and you say, hey, I reserve the right to extend escrow by 30 days, by 60 days, by 90 days, and I'll pay for your rate lock extensions. I'll even give you $5,000 if I exercise my ability to extend. And now you've bought yourself an extra 3-4 months to identify instead of only 45 days.
Yeah, that's really smart. Looks like Joe Williams has a question. He wrote one in, but he's also got his hand raised. I don't know if he wants to jump on here and talk to us in person, or I can read the question as well. But let me start with that. I'll read the question that he said. It says, with the lack of inventory, what issues are investors facing now with doing a 1031 exchange in today's market?
Yeah, that's a great question. I feel like we kind of just touched on that. Right?
Yeah, a little bit, yeah.
I think the risk of low inventory is you've got to have some backstops on what if this thing fails, right? Mm-hmm. And so that's where you might even, you do have the ability as a seller to say you can put in what's called a contingency of finding a replacement property. And you can say, hey, I've got 25 days to back out of this sale if I can't find something to buy. The downside of that is that if a buyer has to carry that uncertainty, it's usually at some discount. It's a buyer wants to know that if they're moving forward and taking themselves off the market, that they'll be able to close. But that is another option that you'd have as a seller is holding back some kind of loophole to get out of the deal if you can't find a replacement. And then the other thing is the reverse 1031. Reverse 1031s are a little bit more expensive. I think they're about $7,000 to $10,000, and you basically have the ability to purchase a property using a trust, using the qualified intermediary that actually sets up a trust to buy that future property before you sell your property. So if it's really, really easy to sell a property and really, really hard to buy a property, which is kind of that market we're in now, a reverse 1031 exchange is also a good fit.
Okay. One of the other things that we see with this is if you're moving inside California, being aware of the property tax that will change, even though the 1031 for the capital gains will defer those taxes. So that $1 million property that is now worth $3 million, if you decide to, switch that equity up and buy a new piece of property, you're looking at a higher property taxes, rather, if you make that move inside California. Now, that's another good reason to maybe do the 1031 exchange and buy some property outside of the California and diversify a little bit there too. So there's ways to get around it. It's just one thing that we see that people don't realize sometimes is they make that exchange and then, the property taxes that they have built on, Prop 13 from the 70s that they're paying $2,000 on, now they're paying $50,000 on. So that can be a big change.
That's a great point, right? I mean, if you're talking about someone who's held a property for a long time, like you said, 25, 30, 35. I mean, I had a gentleman who he had a beach cottage in Newport he bought for $25,000 in the 60s. And then we sold it for him for 1.9 million, in a weekend. And that happens, right? I mean, just tremendous appreciation. So you do have to factor in that, so that property tax change up. So it becomes more difficult actually to trade, like you said, within California, unless you're just finding a screaming deal or you're changing asset classes or something like that.
Yeah, there used to be an exemption for non-residential real estate, but it's gone now since 2021. So that's a new. We've been seeing a little bit of that with the 1031 exchanges.
Yeah, absolutely.
All right, I'm not seeing any other questions.
One thing that a lot of people ask is, can you go in and out of, like, could you buy land? And you absolutely can. If the intention is to hold it, long term for the purpose of generating income, which even you can do with land, depending on the type of land, you can do that. You can go from a 4-unit building into an industrial complex, into a piece of land, into a strip mall, anything that's real estate for purposes of holding it for rental income.
Yeah. And so that people don't get confused, the 1031 exchange, even though you can go from all sorts of different types of real estate, it is a real estate transaction. And they have similar ones that work semi-well for like transferring businesses, interest and things like that. But those are not the 1031 exchange, and they don't work as well as the 1031 exchange. So just so people are clear about what this is a real estate transaction, but like he said, very tax benefit powered, that allows you to really take advantage of the tax code, and it's built right in. This isn't a workaround or a loophole. This is section 1031 of the tax code, written right into the code.
Yeah, and then there's some, and just one last thing I'll say, there's some nuances, and I always check when it's more convoluted. I always check with my 1031 facilitator and ask questions to make sure that it's going to work. But one unique thing is you might have that person who says, gosh, I've got this piece of property that is highly appreciated, and it's doing just fine, but you know what, I've always wanted to have a home at the beach, and I've always wanted to have a home in the mountains. So you sell that 3 or 4 unit building, you get those 2 homes, which, by the way, you can't occupy personally. They can't be your primary residence. They probably can't even be for you primarily. But if it's Airbnb or VRBO and you're up there the odd weekend and it kind of becomes like a semi-vacation home, I think something like that could work, where now you're getting use out of it, where had you not got the equity out of that real estate investment, that may have been something that you couldn't have pulled off.
Yeah. Okay. Well, I want to thank Jordan for being here and for the great information that he shared. I want to thank all of our guests and participants for coming and spending the time with us. Paige is going to continue to reach out to you guys for more information and more series lectures that we're going to be doing. But we appreciate everyone. Thank you so much for coming. And if you guys have any questions or want to get a hold of Jordan, He gave you his information, which we will also be sending out, but you can always contact us too. We're in contact with Jordan. So if you need to get in contact with him, please reach out, and we can always start looking at other planning options. And this is just one of many. So thank you again, and have a great afternoon, everyone. Thanks.
Thanks so much.
Thank you, Jordan.
Thank you, guys. That was fun.